As the Philippines recovers from a deadly storm that hit earlier this month, the economy finds itself wading through rough waters. Mangkhut was the 9th typhoon this year and the strongest since 2013. The destruction it caused underscores the need for better infrastructure in the nation of 7,000 islands.
Most damaged our rice plantation and watermelon and fisheries. There is more hectares was damaged.
The government of President Duterte has made spending on infrastructure a pillar in its economic agenda. In the first half of this year, spending on roads, bridges, and airports rose by 41%. It's part of what the administration calls its Build, Build, Build program. That's helped fuel economic growth in the face of slowing global trade and rising fuel prices. Domestic output grew by 6% in the second quarter. It outperformed neighbors like Indonesia, Malaysia, Singapore, and Thailand. The government has set a target of 7 to 8% growth for the full year. But the administration's higher spending on infrastructure means more steel and cement imports. It also buys nearly all of its oil from overseas. The need for dollars to buy imports, coupled with a rising greenback, has put pressure on the peso. The currency's down 8% this year, making it one of the worst performers in Asia. That's also pushed up inflation, which reached a 9-year high of 6.4% last month. The central bank moved to counter rising prices by hiking interest rates by 0.5% on Thursday. That follows a hike last month. Analysts say the currency headwinds should not distract from the otherwise rosy economy.
As compared to what we're seeing in other countries like in emerging markets like Turkey, Latin American countries where their problems are dollar debt. We get the same symptoms, but we're building our future. We're trying to eventually build infrastructure and in the process creating jobs and eventually building our biggest asset, which is human capital.
Ravella says many of the problems are part of a storm that's formed overseas. The Philippines will just have to weather that, like it's done so many times before. Paolo Montecillo, TRT World.
And Rajiv Biswas is Chief Asia-Pacific Economist at IHS Marki. He told us about the impact of higher rates on the Philippine economy.
The Philippines economy has faced new challenges this year because inflationary pressures have been rising for a number of reasons. We've seen inflation continuing to escalate all the way until August, when it reached a rate of 6.4%, which was well above the central bank's target range. And as a result, they've hiked interest rates by 50 basis points today, on top of 100 basis points of action earlier since May. So altogether, that's 150 basis points of tightening within very few months. So this is going to have some impact on economic growth. The time frame in which monetary policy acts on economic growth is quite long. So we're not going to see the full impact probably for a period well into the middle of next year, but it will have an impact on growth. Plus, the likelihood is that the central bank may even tighten further. So I do think that we're going to see growth momentum in the Philippines economy slowing down in the second half of this year and perhaps even early next year. But still, I think the economy is growing relatively strongly, so it can probably cope with this level of tightening without having too much negative impact